About 7 million people nationwide have a distressed mortgage, meaning they are at least one payment behind on their home loan. Now the government is trying to help out these troubled homeowners with a new program called HAMP, which stands for Home Affordable Modification Program. And joining us now to tell us more about this program is Matthew Heimer, Deputy Editor for Smart Money. Good morning.
Good morning.
Matt, thanks for being here. Tell us about this program in general.
Well, the general idea is they're trying to put more federal money into making mortgages more affordable. You mentioned the distressed mortgages. These are basically people who are already behind on their payments, often because either their income has dropped because they're unemployed or because their mortgages have gotten to be much higher because they had an adjustable rate mortgage. What HAMP is trying to do is basically refinance a lot of these people into mortgages where the amount they owe is just lower.
We saw one other program similar to this right beforehand, but this is a little bit different.
This one's wider. It's sort of painting a bullseye on more people. The old one was really targeted almost exclusively at people who lost their jobs. What's different and somewhat controversial about this program is you can qualify even if you haven't had economic hardship if basically the value of your mortgage is now a lot more than your home is worth.
Okay, so tell us about the criteria specifically to qualify.
You bet. Well, first of all, to qualify, if your income has gone down, either because someone in your household lost a job or you're self-employed and business isn't so great, that's one category of people who can qualify. Another is people whose mortgage payments have gone up because they have an adjustable rate mortgage. And the third category is people who are what they call underwater on their mortgages, people who owe a lot more than their house is worth because the value of their house has sunk in the housing crash.
That is such a hard situation to find yourselves in.
Really is.
Now, if you are there and you're looking at qualifying, there's some magic numbers.
Right. There's two to keep in mind. One is 31%. If your monthly mortgage payment is more than 31% of your total take-home pay, and that's everything from Social Security to unemployment benefits to your actual paycheck, that's one threshold. If you clear that, you might qualify. The other magic number is 115%. If the amount you owe on your mortgage is greater than 115% of what your home is worth, then you can also get relief, and that's what's really new. And that might sound like a big number, but if you bought a house at the peak of the housing boom in like 2006, 2007, you could be in this category.
Yeah, which will happen to so many people.
Exactly.
Now, if you're going to get your application together, what kind of documents are you thinking that you might need?
Well, first of all, you're going to need to prove your income, especially if you're in one of the hardship categories, So basically that means pulling together pay stubs. If you've lost your job, maybe evidence that you have been laid off. Unemployment benefit stubs are also important for that. There also is a tax form that you'll need to fill out. You're also going to need to get in touch with the company that services your mortgage. That's important to note because it's not necessarily the bank that you borrowed from. This is the company that mails you the statement every month and the company that you mail your check to. So, so those are the main paperwork steps.
Now, even though you might qualify, it looks like you might, there's the fine print and the hiccups.
Yeah, there's a lot of little obstacles. For one thing, if you have a great big mortgage, like a lot of people on either coast, you won't qualify. Your mortgage has to be less than, it's about $730,000. Otherwise, you're not eligible. It also has to be the home that you live in. This is not the way to save your beach house. It has to be your primary residence. And finally, your bank does not actually have to play ball with this. It is at the lender's discretion ultimately, and they may just decide that either you probably do have the resources to keep up with your payment, or there's some other thing, like maybe your credit's not good. There are different ways that you can kind of get bumped out.
If the lender won't play ball or you can't qualify and you have to consider Plan B, what are you thinking then?
Well, there's a couple different options. One is called a short sale, which is where you basically sell your home for less than what you owe on the mortgage. Under some circumstances, the bank will play ball with that. Another thing is called a deed in lieu of foreclosure, which is basically where you agree to give the house to the bank without going through foreclosure. The reason those can both be good things for consumers is that a foreclosure really destroys your credit rating and makes it hard to get another mortgage for years down the line. If you do one of these other options, your credit won't be hurt that badly. You can sort of start to get your financial life back together, live someplace you can afford, and kind of get a clean slate.
Sort of good for you, good for the economy, and get things forward.
Yeah. It's actually even better for the bank, too, because processing a foreclosure is really expensive and a big pain for a bank, frankly. They would rather, a lot of them, see you go one of these other routes if they can swing it.
All right, Matt Heimer from Smart Money. Thanks so much.
My pleasure. Thanks for having me.